Hello and welcome. This discussion is brought to you by the team here at My Tax Accountant. We're going to be untangling a topic that, let's be honest, can feel pretty overwhelming: inheritance tax. And we're going to focus on one key question. What exactly is an accepted estate here in the UK?
Look, if you've ever had to deal with a loved one's affairs, you know just how difficult that time can be. The absolute last thing you need is to be drowning in a sea of complicated tax forms. It's a real headache. But, and this is the good news, there is often a much simpler way forward.
So, to help you navigate all this, here's our roadmap. We'll start with what we're calling the inheritance headache, and then we'll show you that simpler path of accepted estates. We're going to break down the three main ways to qualify, highlight the key numbers you really need to remember, explain what this all means for the probate process, and finally, talk about getting the right professional help.
So what is this simpler path I'm talking about? Well, it all comes down to a special classification called an accepted estate. Honestly, getting your head around this is the key to avoiding the full and, frankly, very complex inheritance tax process.
So what does that actually mean in plain English? Well, it's pretty simple. It means that HMRC has a set of rules that allow certain estates to skip filling out the full, detailed inheritance tax account. This makes the whole administrative journey so much more straightforward and, believe me, a lot less stressful for everyone involved.
And this right here is the main prize. This is the big benefit. You get to avoid filling in the famously long and complicated IHT 400 form. This is a huge deal. It saves time, it reduces a ton of stress, and it cuts down the mountain of paperwork for the executors.
Okay, so this all sounds great, but how does an estate actually qualify to be accepted? Well, there are three main ways, three paths you can go down. Now stay with me here, because understanding which of these three categories an estate might fall into is probably the most important step in this whole thing. So these are the three routes we're going to explore. First up, we have low-value estates, which, as you can probably guess, is the most common one. Then you've got exempt estates, where it's all about who inherits the assets. And finally, there's a pretty specific category for people who weren't permanently living in the UK. Now, before we dive into the details, this slide shows a really key difference between low-value and exempt estates. For a low-value estate, the focus is on the gross value. That's the total value of everything before any debts are paid off. That has to stay under the limit. But for an exempt estate, the gross value can actually be much, much higher. What matters there is the net value, what's left after you've applied big exemptions, like gifts to a spouse.
Right, let's start with Category 1, low-value estates. The name gives you a pretty big clue, but getting the specifics right is absolutely crucial. This is where most people find they can use the simpler process, but it's also where simple mistakes can easily happen.
The very first number you need to burn into your memory is £325,000. This is what's known as the nil rate band, or NRB. The easiest way to think about it is as the main tax-free allowance for a person's estate. If the estate's total value is below this magic number, you're on the first step to qualifying.
But, and here's where most people go wrong, it is not just about that one number. To qualify as a low-value estate, you have to pass through all of these different checks. Yep, the gross value has to be below the threshold, but then you also have to check the value of any trust assets, any assets held abroad, and any large gifts given away in the 7 years before death. Each of these has its own separate, smaller limit that you have to be under.
Okay, let's make this a bit more real. Meet Asha. She's a freelance designer living in London, and she's the executor for her father's estate. The total value is £310,000. Now that's below the main threshold, and her dad hadn't made any large gifts or set up any trusts. Because it meets all those other conditions we just looked at, his estate qualifies as a low-value accepted estate. And that means Asha gets to use the simpler probate process. No IHT 400 form for her.
Okay, let's move on to our second category, exempt estates. Now this is where things get really interesting, because this can apply to estates that are worth way more than the basic limit, but which can still be exempted and pay absolutely zero inheritance tax. This category is incredibly powerful. An estate can be worth up to a whopping £3 million and still qualify. The key, the absolute deal maker, is that almost everything is being left to someone who is exempt from inheritance tax, so a surviving spouse, a civil partner, or a UK charity. Once you apply that huge exemption, the little bit that's left over has to be below the normal nil rate band. And of course, those other little limits on foreign assets and gifts still apply.
And this quote from a client is a perfect real-world example. An estate worth £800,000 is clearly way over the basic tax-free limit. But because everything was left to his wife, the spousal exemption wiped out the entire value for tax purposes. This made it an exempt accepted estate, and the whole process became so much simpler for the family. That spousal exemption is one of the most important reliefs in UK tax law.
Right, our third and final category. This one is for individuals who are considered foreign domiciled. Now that's a technical term, but it basically means their permanent home, their real home, was outside of the UK when they passed away, even if they owned some property or had a bank account here.
For this category, the number to remember is £150,000. If the person who passed away lived permanently abroad, but they had assets here in the UK, their estate can be treated as accepted as long as the total value of just their UK-based assets is less than that £150,000 mark. It's got nothing to do with their global wealth, it is only about the value of what they held here.
Okay, I know we've thrown quite a few numbers around, so let's take a breath and put all the key tax-free allowances together in one place, just to make it crystal clear. Now, what's really amazing about this table is seeing how these allowances can all stack on top of each other. Everyone gets their own £325,000 allowance. Then, you can often add another £175,000 if you're leaving your main home to your kids or grandkids. And, this is the big one, any unused allowances can be passed to a surviving spouse. So as you can see right at the bottom, that means a married couple can potentially pass on up to £1 million completely free of inheritance tax.
And here's a quick pro tip for you, something that catches a lot of people by surprise. In most situations, pensions are not counted as part of your estate for inheritance tax. Why? Because they're technically held in a trust by the pension company. This can be a massive advantage when planning, but the crucial point is you must always check the specific rules of that pension scheme, because they can be different.
So, we know what an accepted estate is, but what does that actually mean for the paperwork? What does it mean in practice? Let's quickly look at how it changes the probate process itself. The good news is that for deaths after the start of 2022, the process is a lot more streamlined and it's mostly done online now. So you confirm the estate qualifies, you gather up all the valuations, and then you fill in the right probate form online. But the critical difference, the whole point, is step 4. You get to submit your application directly to the probate registry without having to fill in and send that monster IHT 400 tax account to HMRC first.
But that's not all. Knowing when you can use the simple path is only half the story. It is just as important, if not more so, to know when you can't, when filling out that full inheritance tax return is completely unavoidable.
You will definitely have to file a full IHT 400 if the estate's value is just too high and there are no exemptions to cover it. You'll also need to do it if the estate is complex. Maybe it involves things like business relief or has a few different trusts. And those large gifts made in the 7 years before death, if they use up the tax-free allowance, that will also trigger the need for a full return. If you tick any of those boxes, the estate is not accepted, and that's the point where getting professional advice really becomes essential.
And that leads us nicely into our final section, how you can navigate all of this with confidence and make sure you sidestep the common mistakes that can end up being very expensive.
Even with what seems like a simple accepted estate, there are traps you can fall into. The most common mistakes we see are people getting asset valuations wrong, which HMRC can come back and question later, completely forgetting about gifts made years ago, and crucially failing to claim every single tax relief they're entitled to, like transferring a deceased spouse's allowance. Any of these mistakes can turn a simple job into a nightmare.
So if you're feeling at all unsure about any part of this process, the single best thing you can do is get professional guidance. The friendly team at My Tax Accountant are absolute experts in this area. They can help with everything from just confirming if an estate is accepted to full-blown inheritance tax planning and administration. Their contact details are on the screen right now. That's phone number 0208-570-8531, or you can email them at info@mytaxaccountant.co.uk. And finally, if you found this useful, please do subscribe to their YouTube channel for more clear, practical tax advice. Thanks so much for joining us.